Welcome back to Dividend Obsession, where today we're going to begin something new. For the foreseeable future, on Mondays, I'm going to be doing a new series that I'm going to call Dividend Discussions. The main goal of this series is to speak with people from all different walks of life that are in different parts of their dividend journey and see how they do dividends to see if I can help them, they can help me, and if we can help you, the viewer. The very first discussion here is with my friend Chad, who is from the Dividend Growth Investing Facebook page and also has his own YouTube channel at Total Growth Investing that I will leave a link to down in the description below. In this very first episode, we spoke on common mistakes made by dividend investors, what keeps Chad going in his dividend journey, and plenty of other topics. So without further delay, please enjoy the show. Welcome to Dividend Obsession. I'm trying something new here. We're going to call it the discussing dividends or whatever you want to call it. So I am here with my friend Chad from the he has his own YouTube channel, Total Growth Investing, and he's also in a couple of the groups that I'm in on Facebook. So Chad, if you want to give yourself a brief introduction.
My name is Chad Lupkes. I'm in Seattle. I actually got started in investing back in 2000, and we'll go into more of the history as we go along. But about 5 years ago, I found the Dividend Growth Investing group, and I was active enough that they made me a moderator, and now it seems like I'm one of the primary moderators. And I built a big network of files and information for Total Growth Investing, including content creation on YouTube and a bunch of advice documents that a lot of people get a kick out of. So I basically have a lot of lessons learned from making a whole bunch of mistakes, and I'm trying to prevent other people from making those mistakes.
There we go. You gotta like that because I always say it's you always have to learn from mistakes, but they don't have to be yours. You can learn from other people's mistakes.
Yes.
So, I mean, you kind of went over this a little bit. So the first question I have for you is, what got you into dividend investing, and when did you get started?
Well, let's see. I think what I'm going to do is show my dividend history because it sort of maps out what I'm going to talk about. So if I go back to here and share my screen, on a window, this one, and can you see that one?
It says you. There we go. I can see it.
Okay. So I'm going to show this one because this is the one that I show if I am talking and answering this question for people. I started investing back in August of 2000. I was just divorced, and my life was not really easy at that point. And this new company in Bellevue, Washington opened up. It's called ShareBuilder, and they did something that I had never heard of before. It was dollar-based investing, where you could put in $10, $25, $50, and buy as much of a share of stock that money could buy. Everybody else was saying you've got to buy 10 shares or 100 shares. And in 2000, that was a lot of money. ShareBuilder got a lot of attention by doing dollar-based investing, and I opened an account and I deposited $45. And my first investment was Texas Instruments. It's one of the only ones I still own. I didn't do that much with it over the first 10 years, as you can probably see. But then I bought AT&T, and AT&T is it's big in the dividend groups. It's not that great of a company, but it pays a decent dividend, and it always has. It's an income stock. Mm-hmm. And I put like $1,000 into it because I had a little extra out of a tax return. And that got my attention. And so for another 5 or 6 years, I built up on that. And then around 2010, you can see where this starts going up. That's when I discovered high dividends. And what I was looking at are the mortgage REITs and the ultra high 5%, 10%, 15%, even 25% stocks. Okay. And they were all the rage as far as I was concerned because this is a get rich quick mentality. Mm-hmm. And it's the American dream. You get rich quick. Mm-hmm. So I started getting rich quick, sort of. And as you can see, my revenue stream, this is annual here, and this is quarterly and monthly. So if we just look at the annual, you can see how fast it was going up. And it just kept going up. And right about in 2019, I had a friend of mine ask me to start looking at what my portfolio was doing. Not the revenue stream, the nest egg. Because there was a difference, and I hadn't understood what the difference was, or that there even was a difference. And what I realized when I looked at the stocks that I owned is that my revenue was going up, but my portfolio value was going down because the stocks that I owned were losing money over time. It looked like I was doing well because of the revenue stream, but if I ever had to cash out for an emergency or if I wanted to buy something big, I wouldn't have had enough. So that got me reworking my ranking list away from high dividends to what I called total growth. And what that meant to me is focusing on what a company has been doing over the last 10 years in terms of dividend growth and price growth. And what I found is a resource for that raw data. Seeking Alpha was the best one that I found because they literally mapped it out. They showed you in numbers what the dividend growth rate was for 1, 3, 5, and 10 years, and then what the momentum was for both regular price and total return, and there's a difference between the two, for 1 month, 3 months, 6 months, year to date, and then 1, 3, 5, and 10 years. So I looked at the stocks that I had on my portfolio, and I added in all the numbers. All of this was manual entry. I don't have enough coding skill to be able to do any of this automatically. But once I finished filling in the 1, 3, 5, and 10-year data for dividend growth and price growth total return for all of the stocks that I had been buying because of their high dividends, and I ranked them based on how well they've been doing, I found that most of the ones that I had were at the very, very bottom of the list. They were the worst stocks for me to own if I wanted to get growth out of my portfolio.
That's where you just change the filter to the other way, and then they're the top ones.
Yeah, that's what I had been doing. I've been focusing on the high dividend income stocks that were not growing. And when I looked at the data and said, okay, so which stocks are growing? Which ones should I buy if I want to change my strategy like that? And I'll share my screen again so we can see what happened. I dropped my revenue stream from just over 3,000 to just over 300. I dropped it by 90%. And that was in June of 2000. And right about there. And I watched my portfolio revenue stream drop for about a year, and then it started going up again. And this is what I'm doing now, is tracking it every single transaction. And this spreadsheet has everything if we really want to dive into it deep. But I'm watching my annual, quarterly, and monthly averages go up over time. And I'm growing at about 25%.
Yeah.
Which is honestly pretty good.
Yep, that's really good. So it sounds like my next question was going to be, what type of investor would you say you were when you started, which we know it looks like you were a yield investor.
Well, when I first started, the first 10 years is what I call a dartboard strategy. I was just throwing darts at whatever looked good on the board.
So I started with Robinhood, and I remember my stock filtering strategy was quite literally I think there was a tab at the bottom, like somewhere in the middle, that would show you like the biggest winners and losers of the day.
Yes.
That was my strategy. Because if this stock won, whatever stock it was, if it won today, it's got to win tomorrow. Like that's how science works. So that was my strategy. So question for you then, because I know, being in the groups that we're in, a lot of people when they first get started in dividends are attracted to that high yield. What do you think what do you think causes that?
Honestly, I think it's the get rich quick mentality that the United States pushes on people. Um, we see, I mean, in the 1980s, there was this television show, The Lifestyles of the Rich and Famous, and everybody wants to have the mansion, everybody wants to have the Lamborghini, okay? And the fastest path that you can get to that really looks good. And when people are just starting in the markets and just starting with investing, if they see that they can get a 10 or 15% return, then that's what they want. The problem is that that's a snapshot number in time. Okay? As of today, with the way the stock value has been, if you take the dividends over the last 12 months and divide those by the stock value, you're going to get 10, 15, 20%. But what that doesn't tell you is what that stock value is going to do in the future. Because if your dividend yield is 20%, and we could do math if you want to, but if that stock value continues to go down, your dividend yield is going to look like it's still going up, but the dividend number is not going to change. And if a company is losing value in the market, if their stock price is going down, that means that the market doesn't like them. It means that the people who invest in the market, the institutional investors, they are looking at the fundamentals of that company and saying, I'm not buying that stock. In fact, I'm selling what I've got, because if I keep my capital in that investment, it's going to lose value over time. It's going to lose me money. So that's where the dividend yield can be nothing but a trap. Now, we're talking extreme cases, but when you talk about 10% or 15% yielding stocks, yeah, those are the extreme cases.
Yeah. Well, and the thing that I always try to explain to people, especially those that are newer into dividends, is just because somebody makes a lot of money in their dividend portfolio doesn't necessarily mean they know what they're doing, for that exact reason. Because you can put a small amount of money into dividend stocks and make a relatively decent amount by chasing those higher yielders, those 10, 15, 20% yielders. But that doesn't necessarily mean, and those are the people, I mean, you have a YouTube channel as well, Total Growth Investing. Those are the people that seem to get the quicker followings and stuff like that, because they're, oh, here's this list of 5 stocks that are all above 10% dividend yields. But then when you actually break it down and look at these stocks, and you're just like, okay, I often say it's like, okay, this dividend company A, gave you $75 in your left hand in dividends, but then took $100 from your right hand in capital appreciation.
Yes.
So it's often like a sleight of hand trick. They're almost like magicians, where they're like, oh yeah, look over here. Don't worry about what we're doing to your right hand. Just look at your left hand. So
exactly. And that's the mistake that I was making in the late 19s, late teens, is I was looking at the $2,000, $2,500, $3,000 a year that I was bringing in dividends, and I wasn't even paying attention to my portfolio value.
Yep. That's not even, so if what Chad is saying speaks to you guys that are watching this video, that's not anything to feel shamed about, that you might be in that boat. What it is a understanding that Chad and myself have fell for this. It's common for, I'm pretty sure 90% of dividend investors at one point or another have been like, why would I buy this one stock that has a 0.5% yield when I can buy this other one that has a 4% yield?
Yeah. And to make things even muddier, nobody is saying that the particular investments that you have invested in are bad investments. I mean, the ones that you have picked might be the exceptions to the rule, and they might make you rich.
And it's all
if you're willing to make that risk, that's on you, and that's your choice. And nobody should be able to say you made a bad choice. The only person who can say that something was a bad choice is you in 10 years when you look back on what your opportunity cost was.
Yeah, and it's one of those things where the high dividend stocks aren't always a bad idea either. It also comes down to where you are in your timeline. Are you at the
And
point where you
and how comfortable you are with risk.
Exactly, yes. If you are to the point where you need the income and you're retired and the dividend portfolio is maybe supplemental income or something like that, and you're closer to that retirement goal, that's where some of the higher yielding investments can be in your favor. But like I said, often when most people are getting started, and you don't have to be young to get started, you can be at whatever age to get started in dividends. But a lot of times it's some younger people that find it on social medias or YouTubes or wherever they're finding it, and they get attracted to these higher yields. And like Chad was saying, it's the opportunity cost. It's not necessarily it doesn't even necessarily mean that your investment lost you money. It's just if you would have had a different strategy, what could you have made?
Yeah.
So that's really the big thing there. I really appreciate those stories and you diving into that. So the next thing I want to ask you is what keeps you going in your dividend journey?
What keeps me going personally? Two things. One, the fact that I am pretty darn sure I'm on the right path.
Mm-hmm.
And it's going to be a slow boat, but I know that if I can keep focused and buying stocks that have been growing their dividend over the last 10 years, and as long as I keep an eye on them to make sure they're still growing, those are the ones that I'm going to continue to invest new capital into. That eventually I will get to the point where I can make that transition. Okay. Right now I'm focused on total growth. What my goal is when I hit 59 and a half and my Roth IRA becomes mine entirely, then I will switch from total growth to what I call healthy income. And that's where I focus a little bit more on the higher yield. And what I call higher yield is like 4%.
Mm-hmm.
Okay. It's not the 10 percenters. It's an average of around 4% over the last 4 years. Those are the stocks that I want to start focusing my new capital into. It doesn't mean that I'm going to sell anything that I own, that I bought during my total growth phase,
Mm-hmm.
because yield on cost for those might at that point be the 4% that I want.
Mm-hmm.
And that would be fantastic. But I'll start putting more capital into healthy growth or healthy income with that 4% yield, and then build that revenue stream up to where it equals my paycheck.
Mm-hmm.
And when my average dividend revenue for a year equals my paycheck for a year, I'm done. I can retire.
Yep. Okay, so I've had this conversation recently with probably more people than wanted to hear it. I'm often like that. I'm really excited about dividends, so I just tell anybody that's got ears. So my thing is, I think one of the biggest things that keeps you going is the same thing that keeps me going, is the fact that you're tracking it, and because you're tracking it, you can see the progress. I know a lot of people that get into dividends and they have zero ways to track their progress. Then they're just like, yeah, I'm, putting money in. And it was almost like your friend that you had where you were tracking that you were making more and more money, but you weren't tracking the whole picture. And then
Right.
when that's a really good friend, by the way. But when that friend was like, hey, there's a full picture to this. You can be really zoomed in, or you can actually zoom out and see the whole thing. The tracking really, really helps that. So what I've been contemplating in my head, for anybody that's been to the channel or watched my monthly recaps, I'm 28. My goal is to retire at 50. My thing I think I'm going to have an issue with is the magic of compounding. So I know that when I get to 50 years old, my portfolio, I don't know, let's just say it'll generate $60,000 in passive income. Right. That's at 22 years of investing, like 22 years from now. I feel like I'm going to look at it and I'm going to be like, okay, I'm 50 right now. I'm generating $60,000 in passive income. If I wait till I'm 51, I'm going to generate $68,000 in passive income.
There we go.
And if I wait till I'm 52, it's going to be 80,000. Yeah,
right.
Yeah. So like
at that point, and let me show you what you're talking about.
Yes.
Okay. Because I have a chart that will show you exactly what you're talking about. Okay.
And so the charts are always super fun for me to look at. The thing I know, because I am how I am, the thing I know is going to be difficult is my goal is 50, but I also like money. So I'm like, okay, if I stay 2 more years, just 2 more years, I can like add $16,000 a year to my passive income. And like, when do I know it's time to just get out of there? Like,
Yeah.
when do I actually say I'm done? I'm okay with this amount. And it like the other thing is what you're probably going to expand on is like, say I'm going to make 60,000 in passive income. I might not need 60,000 to live because my goal is always to reduce my expenses. So I can still at that point still invest. Say I'm making 60 and I only need 40. I can still put 20,000 that year into my portfolio.
Hmm.
So I know that's going
So
to be an issue for me. I know it.
so here's the chart that also keeps me going. Okay, which is exactly what you're talking about. All right, you can see this is an extension. This is an extended dividend projection based on the data that I've been bringing in. And if I can keep growing at the rate that I'm going now, you can see the first 10 years, it was pretty much nothing. And then it grew like crazy for 10 years. You can see the 90% drop. This is exactly what we saw over here. But then using math, you can see, okay, then keeping this dividend growth rate, what will happen? So at about 2029, it's going to equal what I had in 2020. And then it's going to start going up faster and faster and faster. And this is what you're talking about when it's like, can you wait one more year? Can you wait 2 more years? Because the longer you leave it alone and let it compound, the faster it goes up.
Mm-hmm. Yep. Yeah, and I don't. So like that's gonna be your thing. Like you're gonna be like, okay, well I know this replaces my paycheck, but if I waited 6 more months, I could get it to be my paycheck and a half.
Yeah.
So I don't know. I think that's gonna be something that a lot of people have, and like best case scenario, you get to a certain point where you're old enough, the house is paid for, cars are paid for, everybody's out of the house. It's you're just hanging out, and eventually enough is enough, right? You don't like I don't know. Tell that to Jeff Bezos or Elon Musk, but so I don't know. I know that's one
Well,
thing I'm gonna have an
I
issue with.
I do sort of have a plan for that, and that is if I can get it to 110%. Okay, that means, and actually think about it this way: we are saving a lot out of our paychecks to go into investing right now.
Mm-hmm.
Let's say it's 10, 20%. With somebody as insanely obsessed about dividends as you are, maybe it's 30 or 40%. I
Mm-hmm.
don't know. But you're already putting 10% into investments. So when you reach the point where your dividend revenue equals your paycheck, that includes the amount of money that you're going to be investing.
Mm-hmm.
So you keep investing. And the easiest way to do that is to leave some of your stocks on drip.
Mm-hmm.
Okay, so it continues to compound, and you can switch out which ones those are as time goes on, so you don't get too heavy into any one of them or any one stock, or too heavy into any one sector, just like we do with regular diverse investing, which I think is one of your questions. But if we can keep that focus, then even when our expenses are paid out of that revenue stream, we still have the extra revenue that is going to build more assets,
Mm-hmm.
that is going to buy additional assets that build our revenue stream even faster forever.
It when I explain it to people, for example, I just had a conversation with a kid that I talk to in the gym often. I was finishing up my workout. He asked me a question. We got talking about dividends because he has ears and I like to talk. So I was telling him, and like as I explain it to people, the whole method of the drip and the compounding, it almost sounds like a scam. You're like, okay, I'm gonna hold this company. They're gonna pay me money. I'm going to turn around and put that money back in the company, and they're going to pay me more money that I'm going to put back in the company to give me more money. And you're just like, okay, like
Yeah.
that seems a little something. Like you also selling me Bitcoin or something, but
Yeah.
so
Let me try this. Let me try a metaphor for you
Okay.
that will work in a gym.
Okay.
Okay?
I'm ready.
You're building muscle
Yes.
when you're pumping iron.
Correct.
Okay? The more muscle you build, the more iron you can pump.
There you go. That is true.
That's the metaphor.
But in dividend worlds, I don't have to worry about my back hurting. So
no, you don't have to worry about
Yeah.
the fundamentals of the economy.
Yeah.
You don't have to worry. Yes, you do.
Well, you
have
do.
to pay attention to it.
Yeah, you do need to pay attention to it. A lot of it is I've found Now people in the channel know that I like to keep my investing style simple. That not to say that looking at all these different metrics that everybody else seems to know a lot better than I do is wrong. I think it's right, especially if you understand it. I was just under the impression of I get informational paralysis too often, where I look up too many things and then don't make
Yep.
any moves because I know too many things, or I think I know too many
Yep.
things. So in lieu of that, I was like, what questions can I ask myself to, like, basically what criteria can I set for myself to that, one, I can understand, and two, will help me find quality stocks. And I have videos on the channel that talk about that. And it's just one of those things where you have to find. I feel like if you do a good job of screening these stocks and they pass 1, 2, 3, 4, 5, however many checks you have,
Yeah.
that's almost your thing to, like, not worry about the FOMO, not worry about what all these people are saying. Oh, this stock's going to be junk, whatever. As long as you trust your due diligence that you did on your stocks, it could be just a buying opportunity. Just because a stock goes down 5-10% doesn't mean it's, the wheels are falling off and it's a garbage company. Because for a long time, when I was doing my market recaps at the end of the month, Microsoft was my biggest loser. And then Microsoft in one day went up like 8 or 10%, and now it's one of my biggest winners. And like,
Yeah.
I kept saying, you guys can check the tape. I kept saying Microsoft, because I always give my top 3 and my bottom 3. I always said, yep, down here's Microsoft. Guess what? I'm not worried about it. I don't know if you guys know, but Microsoft's not going anywhere. Microsoft is one of the strongest companies in the world. I wasn't worried about, like, it was just bad timing for me. When I bought them, they were down. But if somebody bought them 20 years ago, they were up a bunch. So it was one of those things, like, just keep dollar cost averaging. Eventually it's going to do its thing, and here we are.
Microsoft, Apple, Google,
Yep.
Amazon, all the super giants.
Yep. Even Netflix. Netflix was getting killed for a long time, and I just saw Netflix was up, I don't know, like 8% yesterday or the day before, and I was like, well, there it is. Like, it's back. Like, those Facebook, those things are, well, Meta, those things aren't going anywhere. So, okay, so my next question is your biggest dividend mistake and what did you learn? So we already talked about, the chasing the yield and so can you speak a little bit more on, like, what you, like, the take home lesson that you learned from the yield chasing experiment that you did?
Well, like I said, the data that I was looking at is just how much I was bringing in, what the revenue was, and I wasn't looking at the fundamentals. I wasn't looking at how much I was losing otherwise. And the lesson learned from that is you've got to find a balance. You've got to find a stock that is at least steady with price and with growth, or steady with growth where it's not going to lose and the price is going up.
Mm-hmm.
Okay, if you look at my ranking system, it it gives a disadvantage to companies that don't pay a dividend because those values are zero. Hello, Jack. But if the easiest way that I can do this is to show the data entry sheet that I've got. Let me share my screen again. And so this is the sheet that I use to enter in the data that my ranking system uses to calculate these scores. And what I'm going to do is I'm going to sort this sheet by the scores so you can see which ones are doing well. And the first set is the dividend growth numbers. And you can see they're all in green except for maybe this one little one. And then over here for price growth, so price performance and then 10-year total return, again, it's mostly all in green. And these give an advantage. Now, if you scroll down in this sheet, these numbers start going down. And then at the very bottom, almost everything is red across the board. Now, this is just the way that my ranking system goes, but dividend growth data and price performance, they're both important. And when the only thing that you're worried about is the current yield or what you're currently bringing in or how frequently, like these are the monthly stocks, how frequently you're getting a dividend, you're not seeing the whole picture. So my lesson learned on that was you have to look at the whole picture. You can't just focus on any one criteria. And it works the other way as well. If you're only looking at price performance, then you're not going to be focused on a revenue stream. And that means when you get to the point where you need capital to pay your expenses, to actually retire, you're going to have to sell everything that you have.
Mm-hmm. Yep. Well, and
pay the capital gains taxes.
Yep. That's the now. Hopefully by then, you start doing your planning and you can at least get the long-term capital gains, which is the same as the dividend tax rate. But even still, that is one of the many benefits of dividend investing is if you do it right and things are well planned and well thought out, you not only get paid while you wait, but you never have to sell the asset. Whereas if you buy into your Googles and your Teslas and your Amazons and stuff like that, you get the capital appreciation, and it might be more, it might be less. Again, that's the opportunity cost we talked about. But it's also, one, you don't get paid while you wait, and two, the only way those unrealized gains become realized is by the sale of the asset. And then, I used to own X number of shares of whatever company, and now you no longer do. So...
And I said what my goal was, which was to get a revenue stream equal to my paycheck. I'm middle class. Mm-hmm. Okay, my income is like $50,000. Mm-hmm. With both my wife and I, it's about $100,000. So that's the actual goal, so both of us can retire. But I'm not talking millions of dollars in income. Mm-hmm. Okay, I'm talking you've got a nest egg and then you've got a revenue stream. If you're focused on dividend investing, even if it's all in a pure tax account with no discounts for long-term capital gains, whatever, which is only a year, so yes, of course it's going to be discounted. But you're only talking what you're paying in taxes now. You're not talking a huge 40% bill when the time comes. Okay, yep. You're talking the regular 20%. If you have to sell everything that you've got to be able to finally pay off that mortgage or to go on a trip or whatever, even with the long-term capital gains, that's a huge chunk that you're paying out. Mm-hmm. And you're losing the stock by selling it.
Yep. Yeah, and then, our luck, the stock goes up 15% the next day after you sell it, because that's how it works. And then you're just sitting there real upset with yourself. So, yeah, it is one of those things to really consider. Like I said, I know I'm gonna have a hard time once I hit, because for me, so I'm from Pennsylvania. In Pennsylvania, we get a lot of snow. A decent amount of snow. Anybody in like Maine, you guys get different stuff. But we always knew that when you would look outside and you'd look up at the street lamp when it was dark out and you'd see the snowflakes falling. The big snowflakes, they were really cool to watch and they accumulated very, very fast. But that was the fastest snow to melt. And that's a really good analogy for dividend investing. The small snowflakes, it took forever for you to get an inch, 2, 3 inches, however much. But that snow seemed to stick. It didn't matter if it was 60 the next day. That was consistent. Like that stuff stayed. It took 2 days of it being 60 for it all to go away. So I always try to remember that. Like it's the small dollar cost averaging effort. You're not going to have, random $50,000 you find to throw in dividend stocks and really get you going. And I've said this before in some of my monthly recaps. When you do have a tracker, and if your trackers can tell you month over month, like not necessarily like January to February, I'm speaking more about almost like the year over year, like last January to this January. And it's really important to see that gain. As your dividend amounts are small, like as you're getting, $3 a month or $4 a month or whatever it is, as you're getting that, your percentage, your year over year growth rate is probably going to be pretty high. And that's what can keep you motivated to kind of answer that question of like, what keeps you going? That is something that can keep you going is those year over year growth rates are just wild. And what you need to do is you need to expect that you might have 1,000% year over year growth rate. That's not sustainable unless you're on something that I need to figure out what subscription you have. But what is sustainable is what you do is you transition your focus. So as your dividend amounts that you receive month over month keep increasing, eventually the percentages will get smaller. But then you can really look at like, oh, okay, now I'm actually making $120 this month in dividends. And like now that's enough to pay your cell phone bill or your cable bill or whatever it is. And that's where you can really transition. I'm not at that point yet, I'm getting close-ish. I think I'm going to be getting close to $100 this month in dividends, which is great. But yeah, it's still the year-over-year growth rates that I look at, and it's really nice for me. I have it side by side on my chart, so I can look at both right next to it. Like, that one's bigger. I'm going to focus on that number. So, okay, next question. I got a fun one for you. If you could invest in one dividend stock for the rest of your life, what would it be and why?
If I had to choose one single security.
Yep. And so you have to figure it has to get you to your goal of the growth, but then it also needs to be able to support your income.
That would have to be the S&P 500.
Okay, so we're going VOO on that one?
VOO, SPY, one of those, yes.
So you're going to go with that. So the 1.6, 1.59 or whatever the dividend yield on that you're going to go that over like something like SCHD?
The debate between VOO versus SCHD is a really interesting one. And what I'm going to do, I'm going to pull those up in parallel as soon as that actually starts to load. So my ranking system breaks down strategies for investing in 4 different ways. Mm-hmm. So total growth, dividend growth, price growth, and healthy income. Okay, if we look at VOO versus SCHD, okay, based on this, SCHD is a better growth investment and a better income investment. So
I think I'm swaying you.
Yes, you have. But look at the total return. Okay, the 10-year total return of SCHD is actually lower, even with those better ranking scores. Mm-hmm. If we go to Seeking Alpha, let's look at SCHD under momentum. I can only see 5 years because I don't pay for it, but they're basically identical. Mm-hmm. With a little bit of a bump in the road, et cetera, et cetera. So you're basically getting the same thing, but you are getting a higher yield. Here's the regular yield.
I mean, we're getting the higher yield, but you looked at it, and the chart you looked at was total return. So, I mean, that factors the yield in there. So, I mean,
yeah, it does.
I mean, VOO has been, slow and steady wins the race kind of thing. It's, trending up, and then SCHD is actually on a downtrend. So it was a lot further of a competition than it is right now. But
the current downtrend is coming down from a high watermark. Mm-hmm. Overall, it's basically matched.
Yep.
So it really depends on the time frame that you're looking at. So the difference between looking at it from a 5-year versus a 1-year, it gives a different perspective. If you're only looking at the short term, it's going to look like it's going down. Mm-hmm. But what it's really doing is returning to the norm.
Yep. Yeah, okay, so just to make it harder, it can't be an ETF. Or mutual fund or nothing like that. We can't get fancy. We got one dividend stock. I'm gonna, without much thought, I did not plan this ahead of time, and I actually don't own this stock yet. Stay tuned. I might pick Costco as my lone holding. If I had to pick one, it has a lower yield. It outperforms the market. The dividend growth rate is ridiculous. It has its dividend streak of, I don't remember how much, 19 years, something like that. And has brand loyalty. I mean, there's not too many. You have Sam's Club, BJ's. I think those are your main competitors. And then it also, just for funsies, will throw in a special dividend every once in a while. That is enough to keep me excited, because the special dividends for Costco aren't some, small little drop in the buckets. I think the last one they did was like a year or two ago, and it was like $20 a share or something like that.
Okay.
Which, I mean, if that's the only stock I own, I'm going to have a lot of shares in it probably. So that'd be a nice little Christmas bonus, if you will. So,
I'm going to throw a curveball at you.
okay.
ASM International, NV.
I have probably never seen that stock in my life. So,
All right. So let me share, and I'll show you why.
okay.
Because what I like to do is I like to look at the data. So this is another sheet in my network. Okay, this is the sheet that I use to actually run the calculations that generate the ranking scores. And what I've got over here to the far right is a rank replacement. Now, this is what I use when new stocks come onto my radar that I think might do well and I want to add it to my list. And I'll jump all the way down to the bottom and I'll replace one of the worst performing stocks that I have on my list with something that I think will do better. And what that score also gives me is the best of the best. Now, what this rank replacement does is it literally takes the ranking scores for total growth, dividend growth, price growth, and healthy investing, and the 10-year total return, and it averages them out. So the lowest points, the best scores of each of these rankings is the ones at the top. So right now, the list is sorted in that order. So the best one on my list is ASM International NV. Now, this is a manufacturer of semiconductor manufacturing equipment.
Oh, so that's
Okay?
like the checkmate move right there. Take that,
They
NVIDIA.
are the ones that Intel and Apple and TSM and all of the other semiconductor companies like Broadcom, Texas Instruments, that's who provides those companies with the equipment that they use to manufacture the semiconductors.
That's pretty good.
So let's take a look at this one on Seeking Alpha. It's one of the big dogs. I mean, market cap of 18 billion doesn't look like much, but if you look at the momentum, they're going pretty well.
Yeah.
Okay, total return of 1,590%. Their 5-year chart is going crazy, and no matter what they say, the digitization and the computerization of our global civilization is not going to stop. So I think this would be a good bet.
There you go. I mean, I don't have that fancy ranking scale, so you kind of cheated. But other than that, I think I think that's a yeah. I don't know. Like I have in the Friday videos I do, I get to see two of my favorite categories on there. It's 5 categories. You have your dividend yield, your dividend streak, your dividend growth rate, your 10-year returns, and your stock trading the highest percentage off at the 52-week high. I personally like the middle 2, which would be the dividend growth rates and the 10-year returns. Some of the 10-year returns that I see on these stocks, they're just wild. And as we all know, I know somebody's probably sitting there at their computer, drinking a coffee or whatever, saying past returns aren't, indicative of future success, whatever. One of my counter arguments to that would just be like, would you rather own a company that has shown a past history of being able to be successful and outperform the market, or one like, I don't know, low blow AT&T that has constantly underperformed the market since their existence? Yeah. So I don't know. It's one of those things. Okay, so are you going to bet on the stock like Apple, Microsoft, the stock that always outperform, or AT&T that, oh yeah, it hasn't outperformed yet, but it will? Like, I don't know. So it's one of those things. I know I always get that response. I know you saw, I don't know if you remember, but I know you saw a long time ago on the dividend growth investing page on Facebook that I posted my 3 criteria, which is a stock that has a dividend streak of 5 or more years, outperforms the market over 10, and has a dividend growth rate above 10% over the last 3, 5, and 10 years. Very simple, but everybody on the internet has something to say. So I was like, hey guys, I want to know if there's a flaw in this. please somebody find me a stock that meets all three of these criteria that you think is actually a poor investment. And believe it or not, when the rules were actually followed, I found people that were like, oh, this one's close. I'm like, I don't care about close. Like, we're not playing horseshoes or hand grenades. So it was one of those things. Nobody said anything. And I was like, that is kind of my point, that everything doesn't need to be super complicated. Like, I look into free cash flow. I understand the basics of it and stuff like that. But it gets into the weeds with, like, PE ratio. It's a simple metric, but like PE ratio for this stock is different than this stock, even if they're in the same sector. And then if they're in different sectors, like this sector values more PE ratio, like it's supposed to be higher. And I'm just like, okay, like where's my metrics that I can use across the board? 10-year returns? That seems like across the board, like that's important. So
it is. So here's my own view on that, because when I was building this ranking system that I use, I had the option of diving deep into these super complicated metrics, and it just seemed like arcane magic to me. And then I realized something. Okay, if we look at dividend growth, that is showing how much better the company is doing year after year after year, because it means their margins are going up, their market size is growing, maybe they're entering new markets, their profits are going up, and what they send out to the shareholders is going up. Okay, those are the companies that I want to invest in. Those are the companies that I want stock in, because those are the companies that I believe, I hope, will be the ones that keep growing into the future, because a company's not going to have 10, 20, 30 years of fantastic growth and then say, we're done, we're quitting. That's not going to happen.
Yeah.
Okay?
Well, and the
other half of this is if you look at the price performance. Okay? If you have a stock that has a long-term price growth history, what that tells to me is that the market, the overall market, the institutional investors who have millions upon millions of dollars to put into stocks, what do? They're not throwing darts. Okay? They are hiring the best investigators, the best researchers that money can buy. And those researchers are looking into all of those metrics. They're looking at the price to earnings ratios. They're looking deeper into what the company is doing and how this market or that market is growing and changing, and how, all of the fundamentals that are going into this. And those researchers are telling the big money investors, if you put money into that stock, it will earn you money. It will make you money over the long term.
And a lot of times those institutional investors even have access to data we don't. Like Bloomberg Terminal that costs thousands of dollars a month for the subscription. I'm not paying that. That takes away from my dividends. So they have access to that kind of stuff.
But if you find a company where institutional investors are piling in and the stock price is going up and the market cap is going up, I'm not talking FOMO. I'm not talking fear of missing out. Those are the companies that are being pointed at by the researchers, saying it doesn't matter how much the price is going up. It doesn't matter how big the market cap is getting. Those are the companies that are going to make money in the long term for people who put money into that stock.
Yeah, and one thing to take away from that too is that is just one of Chad's metrics. He doesn't just filter the list every day by which one's getting the most institutional investors. It's kind of like one of the things he checks off of his list. Okay, it ranks at this point in my checklist. It meets all these criteria, and it's getting institutional investors. Like that's what I mean by building your own criteria, building things that you understand, that you value, and that you can. Because if you can't explain, like that's why I'm not a genius. That's why I chose to pick the simple metrics, ones that I've seen correlation to success, and I can understand it. Not only can I understand it, but I can explain it to people and help them understand. So it's one of those things where you can sound smart about knowing this and knowing that, but if your returns are no better than mine, then you're just wasting time, right? Like you're out here digging for 4 hours through all these statements and stuff, but yet we're both we both got 10% last year. So how's that work? Like mine's so simple, and you're out here with pen and pad and calculators and all kinds of formulas and whatever. So
I think I would only push back on that to say that if you really enjoy that kind of research, if that's what you really want to do,
oh yeah,
and
yeah.
you enjoy it and you're good at it, go for it.
Yeah, exactly.
Because the people who are really good at it are the ones that can identify the winners.
Yep.
And that's what supports the market growth.
Yeah. I just want people, my point in saying that is more towards the new folks that feel like that's the barrier that they have to clear, that if they don't understand those things, that they can't be an investor, and that's not the case.
Investing can be as complicated as you want it to be.
Yep.
Or it can be as simple as you want it to be.
Mm-hmm.
The main thing that you have to do is understand where you're coming from and make good choices based on the criteria that you care the most about.
Yep. And your goals, very important. Your goals and your timeline, because like that's kind of going back to our beginning conversation with the yield. Like a lot of people, the yield, and then I see a lot of people, complain when their stocks go down a certain amount, and that's when they get really scared and want to sell. I'm just like, okay, do you care if you put in $100 today and it's worth $80 tomorrow, if you know it's going to be worth $1 million in 30 years when you need it? Like, I don't care on a day-to-day basis what my stock portfolio does. At the end of the day, it doesn't matter because I don't need it today. I don't need it tomorrow. I don't need it next year. I need it 22 years from now. So as long as the fundamentals of the companies that I'm investing in haven't changed, that's a buying opportunity. And I like the dollar cost every day because I am afraid I'm always going to miss a deal. Now, I literally will sit there, and when my portfolio is green, I'm like it's kind of like a catch-22. Like, portfolio is green, I made money on the old money, but now what I was going to buy is more expensive. And I'm like, dang it, now I'm paying more for Microsoft or Apple.
Right.
And then on the flip side, when they go down, I'm like, the money I had in there already, I lost some money, but now I'm getting a 2% discount. Like, I was going to buy it anyway, and now it's 2% cheaper. So
for me, one of the things that I look at is, it's kind of hard to explain, but it's basically the weighted ranking score of my entire portfolio. Okay. And so what I do is I take all of the stocks that I own and I say, what's the ranking score and how much do I own in that? Mm-hmm. And then if you take the weighted average, what I want to buy are the stocks that improve that weighted average. Okay. If you're starting with a brand new portfolio with nothing in it and you buy from the very top of the list, the average is 1. Mm-hmm. The average is because you've got nothing. Right now, my weighted average is 184.12.
So anything you buy that is ranked higher than 184 will drop your rating.
Yes.
Which is, in this case, good. Dropping rating is good.
Yes.
So, yeah, I mean, that makes sense. And so this method works for Chad. He has the spreadsheet, and he actually, it's a file that is available for use for anybody else as well. He's not stingy with it, which is really, really nice. So you also can get rich using Chad's spreadsheet. Results may vary. So that's that's very important to know there. So, Chad, I have one more question with you. I don't want to take up too much of your Friday night. So, do you have any advice for someone that's just getting started in dividend investing? And as a precursor, if you're going to say the typical just get started, what else?
The most important thing for somebody just getting started is actually not to buy a stock. The most important thing is to set up a budget. Mm-hmm. Okay? If you want to get into investing, you need to take stock of your entire financial picture.
No pun intended.
Okay? The money that we bring in is our revenue. That's the income. The money that goes out to pay our bills is our expenses. What we own are our assets, and what we owe is our debt. Okay? You need to take a look and understand your entire structure there. Okay? The goal of investing, the goal of a financial system that works is when your revenue exceeds your expenses, which includes the payments on your debt, and continues to build your assets. When I got out of the Navy in 1994, the most important thing that they said was pay yourself first. Okay? And what they meant by that is pay the 65-year-old version of you that you expect to be someday. Even if it's $10 a month, $10 a paycheck. Okay? Put something away. And put that in your budget, because if you can learn to live without that $10, that $25, that $50, as your income goes up, your ability to put money towards investing goes up, and you can put more towards it. That's the start. That's the first thing you really need to do. Take a look at all of your expenses and make sure you can keep up with it. If your income is lower than your expenses, you're in trouble.
Yeah.
You don't want to be there. So putting something aside right from the very beginning in your budget is the most important thing you can do. Then you decide what assets you want to buy. But you have to have that capital flow first.
Yep. Yeah, I completely agree. I released a video, I don't remember how many videos ago, but it was talking about like the path to retirement. And that changes based on your retirement goal. And most of the path was the same throughout most of the process. Step one for both parts of the process was to create a budget for exactly what you're saying, because just like tracking your dividends, it keeps you motivated to see the progress. It's hard to say whether you are or are not making financial progress without understanding where you're spending your money, where your money's going, how much you're making, things like that. So, yeah, I agree. That's really good advice. I know a lot of people say the just get started. That's why I had the precursor in there, because I didn't want the same answer from everybody. So,
well, there are so many tools out there now that allow you to do this kind of big picture view. I use Mint. Credit Karma has that. Any number of them. And just if you're going to get started with something, get started looking at your entire financial picture and understand what money is coming in, what money is going out, what your total debts are, and start building your assets once you have that full picture.
Yep. And another thing that is very important to add on to that is often people try to out-earn bad spending. So they quite literally, I have this $700 car payment, or I have this Amazon addiction, or whatever it might be. But the problem's not that I have those things, and maybe that I splurge and I shouldn't have. The problem's that I don't make enough at my job. When a lot of times people undervalue what enough is, and they do make enough, but they have a lot of silly spending or bad habits that they do that puts them in the hole that they are. And the other beauty, this is part two of the beauty, is the lower you can get your expenses, the less you need to retire. So it's a double-edged sword. You're out here and you're like, okay, I make whatever, $2,000 a month, and my expenses are $1,900. Okay, well, you need $1,900 a month to live off of. But if you can get your house paid off eventually and your car paid off and get out of debt, maybe you're going to get your expenses down to $1,000 a month. And now you need $1,000 a month to live off of. Obviously, I don't know how many people out here are living for $1,000 a month. But all that to say, like, it's the double-edged sword of, like, I know a lot of people are like, the common age-old question is, when do I invest first or do I get out of debt first? Because, like, you do have the
I wanted to talk about that in particular, because we had a conversation in the group about it today. A lot of people do say, I mean, if you look at the FIRE, the Financial Independence Retire Early, one of the first goals that it has on the list is get completely out of debt. Pay all credit cards off. Pay off your car. Pay off your house. Don't invest a dime in anything until your debt's paid off. And I can't agree.
Yeah, I mean, I don't agree with
I
that.
cannot agree, because debt is part of our financial foundation. I mean, look at fiat currency itself. It's nothing but debt. It's part of who we are as a society. If we want to build a future based on wealth, that's fine. That's great. But we're not going to get rid of debt entirely. So what we have to do is manage it.
Mm-hmm.
We have to learn how to manage the debt that we have. The expenses that we pay every month include the payments on our debt. It includes our credit card payments, our car payments, our house payments, everything like that. Okay? We've got to make sure that our income can manage those payments. If we have extra capital after we pay the minimums, then we have a choice. We can either put that extra capital towards getting the debt paid down, or we can build our assets. That's not a choice to me. We have to do both at the same time. Yes, make extra payments on your debt, but not 100%. Don't spend all of your extra capital to get rid of debt and put nothing away. Split it 50-50 or 30-70 or some kind of a ratio, but always put something away for the future and always pay a little bit more on your debt. That way your debt's always going down and your assets are always going up.
That's a good perspective. I mean, I commonly am under the assumption of there's such things as good debt and bad debt. Good debt being your house, bad debt maybe being very expensive, anything that is a
travel credit card.
Yeah, exactly. Yes. Credit cards, your student loans, if you still have those, I wouldn't count on them being forgiven because nobody cares about you as an individual. Yeah, but like all those things. So like stuff like that, where my personal situation is my mortgage rate is 2.75%, and I have no other debts. So in that case, before I really got into investing and understanding, I always understood money to the point of spend less than you make. Like that's the basis of what I understood, which is really good foundation. But I was never an investor. I was always afraid to invest. I was, I opened Robinhood back in 2017, and I was looking at it, and I was like, okay, I think I pulled up like Apple or Nike or something, and then I looked at it, and like both of those would have been good investments turned out. But when I looked at it and say the stock price was like $100 or whatever it was, I was like, man, I got to put real money into this. Like that's scary. Like I have to literally take money out of my account and put money into this, and I don't know what it's going to do. So it's one of those things. My perspective as far as like the debt thing is, if you have let's just say a credit card, I think I put it in one of my videos. I think the average interest rate on a credit card is like 20% or darn near close to it. I'm under the impression to get that done as soon as possible. I don't like paying off your house personally. Now, like that's what that previous story was about. Especially for me, 2.75%. Pretend inflation's back to 2%. I'm basically asking myself, can I beat 0.75% rate of return in the market? Which I feel like you could almost accidentally beat that. So it's one of those things where I no longer spend extra on my house because that's money that I use towards my investments. And since I don't have any debt, I don't have to worry about that stuff. But
right. But if you do have a whole bunch of credit cards, you want to focus on the highest interest first.
Yep.
And then highest balance.
So that was actually one of, I keep talking about my videos. Follow Dividend or subscribe to Dividend Discussion. But the thing, so there's two different. I'm sure there's more, but the two I spoke briefly about was what's called the dividend snowball and the dividend avalanche. Mm-hmm. So I don't know why everything has to do with snow, but the dividend snowball is the act of paying off your smallest balance first. And that is, in theory, to gain momentum. So if you're paying $30 on this credit card and you have $30, then you pay that credit card off. That one is gone. You no longer owe on that. Then you take that $30 and use it to pay towards the next one. Say that one's $100. Then you get that one paid off. Now you're putting $130 towards the next one, and you just keep.
And this is this is the extra money that you're talking. You're not. You're still making the minimum payments on everything.
Yep. Yeah. Exactly. So and in situations, there's somebody's it always seems to work like this. The ones that have like the introductory periods where there's no interest always seems to be their lowest credit cards, and then their highest credit card debt is always the one that's 27% interest. So that is the dividend snowball, and the dividend avalanche is actually the opposite, where you focus on the interest rate first. It'll take you a long time, but a way to think about that interest rate is that's your rate of return. At least that's how I've thought of it. And I mean, like I said, I don't have any debt, but like if you have a 27% interest, or let's just say the national average of 20% interest on that credit card that is accruing, you're not in a special period anymore. If you can get that paid off, not only is the minimum monthly payment, which is what most people are paying, and the extra, so not only are you getting the minimum monthly payment off of your regular bills, the $300, $400, whatever it might be, but you're also getting a rate of return of 20% or whatever your interest rate is, because you're no longer paying that interest. So you're basically, instead of being at negative 80, now you're back at 100, or you're back at 0. Instead of being negative 20, now you're back at 0. So, I mean, that's my way of thinking about it is it's just supercharging. I would rather see somebody get that debt gone. Like I said, I'm mostly... The car is the last thing. The credit card debt, your student loans, your medical debt, stuff like that, that's first. House is last, and cars somewhere in the middle. And then, like I said, I have a video out that outlines this whole retirement path, and it kind of goes over each of those things as well. But yeah, I don't know. I don't know that there's a wrong way. The moral of the story from both Chad and I is that getting out of debt and reducing your expenses as much as possible will help you exponentially going forward in the future to be able to reach your goals in investing and dividend investing, regular investing. It doesn't matter. The key is to spend a lot less than you make, and then you'll get there.
But at the same time, don't wait to invest.
Yeah, exactly. Yep.
Because, I mean, just like with the high yield or the high balance, okay, if you start early in investing and you don't stop, your nest egg and your revenue stream, when you get to the point of retirement, whether that's 40 years old or 50 years old or 65, is going to be so much higher if you give it that extra time, even just an extra $10.
Yep.
Small amounts add up if you give it decades to compound.
Yeah. And that the guy I talked to at the gym today, he was 19, and I was like, I am willing to bet. There was actually another guy that was walking into the bathroom, and I was like, I know that guy invests. I was like, I guarantee if you walk up and ask that guy what's the one thing he wish he could do or go back and do in his investing journey, everybody says the same thing. I wish I started sooner. Everybody says the same thing. And that's because, just like the chart that Chad showed us earlier in the video with the compounding, the compounding is going to happen as long as you have good quality investments. And if you have good quality investments, the longer you can give it to... Why do you think Warren Buffett makes billions of dollars in Coca-Cola? He's not...
Because he's been doing it for 70 years.
Most people don't even start investing until they're in their 30s, 40s, 50 years old. They don't have 70 years left just because life expectancy. Like, I don't know that's how math works. But like Warren Buffett started so young, and he's also so not young that he's had so long to let the thing work. And Warren Buffett said many of times he's not some genius. He's just done it for long enough that it makes him tons of money. So that's really the big takeaway here. Like Chad said, if you can hyper focus on your debts, and also just say, hey, $10 each paycheck is going towards my investing account. That's at least getting you started, and you can also hyper focus on your your debts and get out of that. And then as soon as you're done with that, all these minimums, whether it's you have minimums and monthly payments and your car payment, that can knock off $400, $500, $600, $700, thousands of dollars off your monthly bills. All that money that you used to spend on liabilities can now go towards assets, and it reduced your expenses in the meantime. So, all right. Well, thank you all for watching this first ever dividend discussion with Chad. I want to thank you, Chad, for spending part of your Friday evening with me. I really hope the goal of these videos is to get different people's points of view and their perspectives and their lessons learned and all kinds of things. And maybe something from that Chad said or I said will speak to you, and you'll be able to get started on your own journey, or correct your journey, or whatever it might be. Because at the end of the day, my plan and Chad's plan will work for us, and yours might be different. And you being successful has nothing to do with us, and us being successful has nothing to do with you. You have to do it yourself. So if you made it here to the end of the video, you're the real MVP. Please use the comment section down below to let me know what you thought of the interview and if you learned anything. Also, if you would like a chance to be in an episode of Dividend Discussions, reach out to my email at dividendobsession@gmail.com and I'll be in contact. Don't forget to leave a like on the video and subscribe and ring the bell if you haven't already, as it really helps me grow my channel. But until next time,